Traders, did you know technical analysis uses simple principles to read price movement? For instance, marking yesterday's high and low helps traders frame today's trading session. Welcome back, traders. In Lesson 11, we showed how technical analysis helps traders read price movement. Today, we'll go a level deeper. You'll see how to spot simple price patterns and use a few basic principles to read charts and make smarter trading decisions. Before we dive in, grab your free Quick Start Guide. It gives you the key terms every trader should know, clear candlestick patterns, and simulator links so you can practice reading price movement with confidence. The link's in the description. Technical analysis starts with Charles Dow, co-founder of Dow Jones and the Dow Jones Industrial Average, DJIA. In the early 1900s, Dow introduced us to how markets behave. His ideas became the basis of how we read charts today. The Dow is one of the oldest and most trusted indexes in the industry. Dow believed prices aren't random. They form patterns and repeat trends. That insight became the foundation of technical analysis, studying price movement to make better trading decisions. Modern traders rely on three key principles to guide decisions. In this lesson, we'll examine each one up close. Principle 1. The market discounts everything. Price already reflects news, earnings, economic data, even sentiment. That's why we focus on price action. Imagine a major tech company announces a new product that should boost profits. Before you even see the headline, the stock may already be up. Thousands of traders and algorithms reacted in seconds. That's the market discounting everything. That's how technical analysts think. Price reflects everything known. You don't need every headline. Focus on price action. Price gives you the full picture. Knowledge check. Traders have to wait for all the news and reports before a stock price moves, true or false. Take a few seconds to think it through and lock in your answer. The correct answer is false. Price moves before most traders even read the news, because all known information is already factored into the price. This is why analysts focus on price movement over reports. Another key principle of technical analysis is that trends follow patterns. This means prices usually move in a clear direction, up, down, or sideways, instead of jumping around randomly. Your job as a trader is to spot the trend early and trade with it, not against it. Think fast. If a stock price has been climbing, the trends follow patterns principle says it'll likely keep rising, unless clear signs show the trend is changing. True or false? Take a few seconds to lock in your answer. The correct answer is true. When prices move in a clear direction, trends often continue until something causes a change. That's why traders look for signs that confirm the trend before taking the opposite side. Remember, the trend is your friend. Principle number 3. Patterns repeat themselves. Traders often react the same way to price movements, driven by emotions like fear and greed. That's why certain patterns keep showing up over time. By recognizing them, you can anticipate future market moves with more confidence. One classic example is the double top pattern. Price rises to a peak, pulls back, then rises again to the same level, only to fall afterward. It's one of the most common reversal patterns, and you'll find it referenced inside our Quick Start Guide. Why does this happen? Because of human behavior. Traders see the pattern and think, hey, I've seen this movie before. I know what happens next. They expect the price to drop after the second peak, so they start selling early. And that wave of selling pressure pushes the price even lower. This is where technical analysis meets psychology, recognizing that price patterns are really patterns of human behavior, commonly referred to as market sentiment. Knowledge check. By studying how prices behaved in the past, traders can often predict how they'll behave again. True or false? Take a few seconds to lock in your answer. The correct answer is true. Price behavior is one of the most powerful tools a trader has. When you study how prices moved in the past, backtesting, you start to see familiar reactions, patterns built on human emotion. That's what gives technical analysis its edge. It's not about predicting the future. It's about recognizing what usually happens when people see the same setup again. Market patterns repeat because traders tend to react the same way to similar price movements. By studying past patterns or backtesting, traders can better anticipate what might happen next. Many beginners think trading lots of different markets means more opportunity. It sounds exciting, always chasing the next big move. But in reality, that approach leads to confusion and inconsistency. Skilled traders focus on just a few markets or stocks. They study how those assets move, how they react to news, and how they behave in different conditions. Over time, that familiarity becomes an edge. When you truly understand a few charts, you trade with more confidence, less stress, and achieve far better results.
Great work, traders. You've just explored the foundation of technical analysis, how price reflects all known information, how trends follow patterns, and how patterns repeat themselves. These principles help you read charts with confidence and make smarter decisions. Up next, we'll take what you've learned and apply it to real charts, so you can see how traders use technical analysis in actual trading environments.
Thanks for watching. Great work today, traders. Want to keep growing? You can start with Trading Made Simple or review Lesson 11. Both are on your screen. Stay consistent and keep learning with Market Mindset University. We look forward to seeing you in the next lesson.